Welcome to Tony Byrne's View with news you can use. Tony has over 32 years of experience as a chartered financial planner and wealth manager. Tony's passion is to help you retire early and live the life of your dreams with no financial worries. Now to today's episode.
The perils of bonds and how to avoid the risks. In my early December blog entitled Why Bonds Are Doomed, I explained why I was so pessimistic about bonds and why you shouldn't invest in them. In this podcast, I'm going to expand on this theme. Bonds, by which I mean gilt-edged securities, otherwise known as government bonds, and corporate bonds, which are, as the name implies, issued by companies, normally publicly quoted companies or PLCs. Investors in bonds are in fact lenders to governments and companies. No different to bank depositors, who are nothing more than lenders to banks. Of course, all of these borrowers are benefiting from record low interest rates. Unfortunately, the same can't be said of investors, who are getting a very poor deal indeed. The risks are different depending on whether you consider corporate bonds or government bonds. It is across the wide range of corporate bonds that there are the biggest risks, because companies are at risk from the economic cycle, whereas governments and central banks can, for quite a while, persist in printing money to keep them out of trouble and push away difficult decisions. In a nutshell, companies have been exploiting very cheap rates and borrowing money through issuing bonds. A significant proportion of the money raised has simply been used for financial engineering, which is a polite way of saying that a lot of executives have been able to line their pockets. This has been enabled by the actions of unelected central banks, with considerable electoral consequences which are very far from over, but that is not our issue right now. Here we just need to be clear that this asset class is in trouble. The bond history. Before jumping into any asset class, it is good to get a long-term picture of the trend and its ups and downs. The console bond yields in the UK from 1750 to date show quite a long trend for really over 100 years of the yields being very consistently around about the level of 5% until there was a steep rise in the 1950s onwards. So what are consols? Console is another word for perpetual. So these bonds have no maturity date. So, as I just mentioned, interest rates did vary really between 2 and 5% between 1750 and 1970, before surging to around 17% in the mid-1970s as inflation took off. As inflation was gradually tamed in subsequent years, in tandem there was a multi-decade fall in interest rates. With interest rates and bond yields falling, this meant chunky capital gains from bonds. Today, bond yields are at a historical extreme. It seems logical that the only direction for interest rates is up. They may fall a bit further in the short term, but we're now playing at the end of a very long cycle. If interest rates and bond yields were to increase, bond prices will fall, resulting in capital losses. There is the added problem of the lack of liquidity in the bond market. If you want to sell your bonds, who's going to want to buy them if interest rates are heading up? It could get ugly. The GMO has crunched the numbers for various types of bonds, and the suggestion is that annualised returns after inflation will vary between minus 0.8% and minus 4.4% in the 7 years ahead. The GMO is not alone. JP Morgan's 2021 investment outlook states that with such low starting yields, government bonds offer little income or upside potential, and it's time to rethink the 60-40 approach to portfolio construction. 60-40, of course, meaning 60% in equities, 40% in bonds, which has been a long-term strategy for portfolios worldwide. Steve Blumenthal, a bond specialist, puts it more bluntly. There is the mother of all bubbles in the bond market. He projects 70% falls in high-yield bonds, though he's very excited about the opportunities at that point, as am I. So how do you avoid the perils of bonds? If you're interested in the traditional diversified portfolio of equities, bonds, property and cash, such as the Byrne strategic passive portfolio, which many of our clients are invested in, you have a number of choices. 1. Increase your attitude to investment risk to risk grade 9 or 10 out of 10, 10 being the highest. At this level, you will invest proportionately more into equities and 0 into bonds. 2. If you have a portfolio worth at least £250,000, consider switching to our Transact discretionary fund management service managed by our associated company Minerva Money Management. As long as you have an attitude to investment risk of at least 7. Our DFM service does not invest in bonds currently. 3. If your attitude to investment risk is level 6 or less, then consider increasing it by, say, 1 or 2 grades, e.g. 4 or 5 to 6 or 7, which will at least reduce the amount invested in bonds. 4. If you wish to remain at risk grade 6 or less, and you are already invested 20% in the CCM Intelligent Wealth Fund as part of our Wealth Investment Strategy, WIS, an 80-20 core satellite strategy, why not consider changing it to 70-30 by increasing your investment in the fund, which doesn't invest in bonds? 5. If none of the above applies, you can simply change your selected Byrne strategy to one that either doesn't invest in bonds or one that invests less in bonds than strategic passive. Fortunately, there is no sign of interest rates rising in the short term, and of course there is an outside chance that the base rate could fall into negative territory for a while. If that were to happen, then bonds could have a short-term reprieve and the value could rise. Nonetheless, this is unlikely to be the case for very long. The truth is, the prospect of rising inflation is increasing, and with it the spectre of rising interest rates, which will be the death knell for bonds. As you can see, there are a plethora of solutions to the bonds dilemma. The key is to take action and not sit on your hands. So do get in touch with us for advice, or wait until your next annual review meeting to discuss your investment strategy. You know it makes sense.
Thank you for listening to today's episode. If you enjoyed it, don't forget to share it with your friends and family. For more information, head to www.wealthandtax.co.uk.